You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Dailey.
Hey guys, welcome back to the Multifamily Journey Podcast. Today we've got on Anton Mattli, and you'll hear today from this show, he's got a ton of experience, a vast background in the financial industry, really international finance and business, has been involved in a lot of different businesses and sectors before real estate. So he brings in a lot of experience, is very knowledgeable, and just as you can tell from listening to him, really knows his stuff. So I think today is more of a nuts and bolts show, but also really entertaining and really insightful for getting lending for multifamily, especially in the current environment. He mentioned some things that as multifamily investors and syndicators, we need to be aware of, whether it's COVID impacts, what to expect, lead time to get the closing. And also a big thing on people's minds right now is the reserve. So what are you going to have to raise in addition to your down payment and any CapEx that you're going to need up front? So he breaks all of that down, and then also gives us a little bit of insight on the funding requirements. You know, as a new syndicator, commercial or just multifamily investor, commercial loans act a little bit differently than residential loans if you've done, residential single family homes before. So he breaks out, like as a partnership, as the GP side, what the net worth and liquidity after closing requirements are when getting these big commercial loans, whether it's agency debt. And then we also talk about bridge loans, because a lot of times the properties that we're investing in have some issues, right? They're not running as well as they should be. And that's where the opportunity is. So the current environment, bridge debt has kind of dried up, and he talks about that and how you can expect to still get loans closed. Maybe it's a little bit more expensive, but maybe it's higher interest rates, but he gives all that insight. So today's a really, really knowledgeable show. So definitely have a pen and pencil out. There's going to be some good topics that we discussed today. And yeah, hope you guys like it. Let's get into the show. All right, Anton, thanks for coming on the show. Good to have you here.
Yeah, thanks for having me, Blake.
Yeah, it's awesome to get to connect with you in person finally after seeing you at the Dealmakers Live conference I was at. We were talking about that a little bit before here. So good to get some personal time with you. But for the people that don't know, why don't you give them a little bit about your background?
Sure. I'm based in Dallas, Texas, but as your listeners and viewers can hear, I'm not from East nor West Texas. So I was born in Switzerland there, went to school, and right after school, after graduated from finance, I worked in New York City and Tokyo, Hong Kong, and then I left banking directly and worked with various family offices and other investors in direct investments. A lot of them were focused on commercial real estate, but it included also some other asset classes, including oil and gas, which was the reason, among one of many, that we moved to Dallas, Texas, and that was roughly 15 years ago. My company is Peak Financing, and we arrange financing for commercial real estate, including multifamily. And as you can imagine, right now, multifamily is a big chunk of our business since COVID-19 hit, because that's still an asset class that's easily financeable.
Yeah, been performing when stuff like office space and other commercial investments might not be. So that's awesome. So with that vast experience, what led you into the lending realm of commercial multifamily, or commercial real estate and multifamily in particular?
Yes, so it was a combination through my work initially. When I started out, and that was in the 90s in New York. When I started out in the 80s, they had the savings and loan crisis. But after that, there was still a lot of hangover of properties that needed to be resolved. And so I was assigned to working out some of these commercial real estate portfolios. And I was kind of lucky because I'm from Switzerland, and there were actually quite a bit of investors from Switzerland and Germany that were German speaking. I was assigned to helping and negotiating with them to restructure their portfolio. So that was my first step into commercial real estate. And then I started investing with family and friends personally in commercial real estate, specifically multifamily. And so that has been the case now for a long time. And at the same time, on the financing side, I have always been involved in commercial real estate financing in one form or another.
Yeah, that's great. I asked that question to kind of set up the next. And I think all the listeners know me. I'm relatively newer in my multifamily journey, have the first deal under contract right now. But you've seen a lot. You've been through different market cycles, different asset classes, different businesses. So drawing from a lot of experience, what are you seeing that is just the overall lending environment? What's it like today? Just really like the broad overview with the COVID implications as well.
Yeah, sure. It's only being in multifamily, apart from the single family space where is financing is still readily available, but in the commercial space, multifamily is really the only segment where financing is readily available, whether it's for distressed assets or whether it's for stabilized assets. When you look at other commercial real estate, naturally everyone thinks about hotels and retail. These are particularly hard hit. Retail is tough unless it's you have a grocery anchor, right, in a very good location. But anything else is really difficult to finance, even when you have so-called national credit tenants, because no one knows whether they'll continue to pay going forward. And hospitality, we don't even have to touch on it. It's still a complete disaster for in that segment. Offices do a little bit better, but they still struggle. And lenders are also still concerned. So I would say in the commercial space, multifamily does extremely well. And industrial, particularly logistic plays, they are reasonably well too. Self-storage is also doing very well throughout that period. But anything else, it's really tough. But when we talk about multifamily, it's just a completely different world, even when you compare it to logistics or any other commercial asset class that lenders are still attracted to, because we have agency financing that is readily available, right? We have Fannie, we have Freddie, we have FHA loans, and that makes up such a massive amount of volume that is being deployed and has been deployed now throughout the summer, spring and summer. Whereas in all the other asset classes, if you want to have financing, it's mostly bank financing, or maybe CMBS loans if it's still available, which is still very tough to have availability. So it's a very tough environment for virtually anyone that wants to finance a piece of commercial real estate, except multifamily. And as you probably have experienced with property that you have now under contract, congratulations, by the way.
Thank you.
So the financing, the debt piece was not really such a big issue for you, right? Whereas if you try to acquire a piece of retail or office or anything else, it would have been a major challenge for you to accomplish.
Gotcha. Yeah. And that's a really good point to make is that the other commercial sectors, whether it be office space or retail, whatever, they've been hit more through COVID or because of COVID. So because of that, multifamily is looking a little bit stronger, and those commercial lenders are now and still have been lending on multifamily, which makes it a really good asset class right now. Because just like you're saying, if you can't fund your deal, it's going to be really hard to raise 100% of the purchase price. The bank is your, if you look at it from this perspective, the bank is your biggest partner in any deal, because they're going to bring 70, 75% of the purchase price, basically. So if they're still lending, which they are in multifamily, it strengthens your position to go out and find a good deal and get it funded.
Yes, definitely. And I would say that there was only a short period in March where even multifamily, it was a a very scary moment. Right? Even some agency lenders didn't fund their deals because, just to give a little bit of additional background there. Agency lenders, they essentially originate that loan and then they package these loans and sell them to Fannie and Freddie. And until they can be sold, they need to have another financing source. And very often they are borrowing from someone else to fund these loans. And during that time period, some of these so-called warehouse lenders, they were not lending, right? So that was a pretty tough period. Also, the market just didn't know how they should price it. So if you had a deal that had to be rate locked, no one was really willing to come up with any price, even if it was a good borrower in the property. But that was really just maybe 2 weeks. That was really scary. And then the situation stabilized, improved quite a bit. Agencies, naturally, they acted extremely fast, right? So obviously they're quasi-government agencies and it's government guarantee. But despite that, one has to really acknowledge how quickly they reacted to it and how they implemented new rules. Some of these rules, obviously, nobody likes that much, right? Which are these reserves, particularly still now with principal interest that are pretty hefty. But at least they said, look, we are concerned about the situation, but we are still willing to lend. And that was the key aspect there, right? Now, also, I think the benefit, apart from the lending side, is that properties have been performing extremely well. Multifamily properties have been performing extremely well throughout COVID-19. Initially, everyone was obviously scared that the collections would drop significantly, and luckily, it didn't happen, right? And that was also a major element that then helped to improve the confidence as we went into July and August, September, and now we are in December, and the confidence level in collections has further improved.
Yeah, there's a couple of things I want to break out there. And I think with what you were just saying there, that the confidence is higher among buyers. And I think that goes to the fact that multifamily has been performing through COVID. But is there one class or a couple classes that have done better, like A class, B class, C class, that have been easier to get lending on in this environment because of, you break it all the way down to the tenants that are living there and jobs that have been affected. That's kind of what determines your class range. So is there a class that you've seen performing better through COVID and making them easier to get lending for?
Yeah. So when it comes to the lending between A, B, and C classes, we haven't really seen any distinction between those in terms of availability, as long as the property has been stabilized. So that was really more of the key driver. As long as the property is stabilized. And
real quick, Anton, can you explain what a stabilized means in commercial multifamily for those properties?
Sure. As a general term, we call it 90-4-90, which is 90% physical occupancy or more for the last 90 days. So that's different from the economic vacancy, obviously, right? So it's strictly the physical vacancy. And as long as a property meets that requirement, and obviously assuming that the property is not crime-ridden and doesn't have major deferred maintenance issues and massive amount of bad debt, then that property we would determine as being stabilized, which means that an agency will be willing to lend for that property. And as soon as you have that requirement, it doesn't really matter whether it's an A, B, or C property. The agency financing will be available for that, right? The tougher segment, even if it's an A class or a B class, are the ones that are not stabilized, right? So properties that were recently constructed, still in the early lease-up phase, they are a challenge to get a permanent financing. Let's say in the past, when you were at 60-70% occupancy, you could start talking about the permanent financing. Now that's a much tougher discussion. When it comes to B and C class properties that are not stabilized, it's much tougher now to get a bridge loan because a lot of bridge lenders, they disappeared. They haven't come back yet, even today. And the ones that are still active, they are typically the stronger players, and they are able to handpick the properties and sponsors that they like. So there it's much more the markets that matter, the sub-markets, the sponsor quality, and the story behind it. So in the past, virtually any deal that was not stabilized, you were able to find a bridge lender, right? So bridge loans really have exploded over the last few years. There was never more availability for bridge loans until February of this year. But a lot of these lenders disappeared, and the ones still active.
And that's a thing we've, my team and I have been dealing with as well, right? Is finding a property that's stabilized because you get the better financing for them. But some of them, either they need renovations or there's, some kind of COVID impact or something that's causing them to be under the 90% occupied. And they're not well situated to get the good agency debt. So then you start to look at bridge debt on those, and it changes the numbers, right? Because the interest rate goes up, the terms get a little bit worse, prepayment penalties. There's a lot of things you deal with there. And that's when you're talking about like the strength of the operator, the syndicator, right? Like the track record with that team. So, and this is all stuff I want to get into a little bit on the lending side. But before we get there, I think it'll be important to just note, like, for a new syndicator, what are some of the lending related things they need to be aware of before they get into a property to make sure that they're well situated? Because I think the current financing, because like you're saying, there's not as many bridge lenders, so the current financing is a little bit different. So what do these new syndicators, new multifamily investors need to know about current lending?
Yeah, that's a very good question, right? Particularly for someone who comes in from maybe single family, right? And a lot of new syndicators may have already invested in single family. They've done it on their own, right? And when you're active in that space, it's your personal income that primarily drives your ability to get a loan, right? So it's your debt to income ratio, the property's cash flow may be available to count in at some point in the future once it's seasoned. But the reality is it's your personal combined income that drives that primarily on the single family space. Whereas on the commercial side, it's the property's cash flow that essentially drives the loan amount at the property level. However, it's important to understand that as a syndicate, you still need to bring financial strength to the table. It's just not your personal income. Now it is your net worth that you bring to the table, as well as your personal liquidity as a percentage of the loan amount, right? Now, the big, generally speaking, obviously with banks, it's a little bit different because when you go to a local bank, particularly community bank, they may be willing to work with you. But when it comes to the transactional lenders, whether it's CMBS loans or obviously in the multifamily space, particularly Fannie and Freddie, the general standard is that net worth has to be equal or higher than the loan amount, and the post-closing liquidity, as a general rule, for Freddie SBL, it's a little bit smaller right now, but as a general rule, you should assume it's 10% of the loan amount or higher, right? Now,
and this is for the personal, for these two,
for the personal,
these are for the personal of the main operator, correct?
That's right. Now, what is important also to understand here, and that's the beauty really of commercial real estate, including multifamily, is that you can, as we call it, stack your net worth and liquidity, right? So you may have, if you look at the property that, let's say, is $5 million, and you think that you can get a loan for $4 million, as an example, your net worth would have to be $4 million, and your post-closing liquidity would have to be $400,000, right? So you may say, well, I have only $1 million in net worth, and I have only $100,000 in post-closing liquidity after down payment and all that. So what do I do now? So if you do it on your own, you're stuck and you will not be able to get that financing done unless you may go to a hard money lender or whatever, that some of them may be willing to give you the money at a pretty hefty premium. But if it's a property that meets the agency or the traditional bank standard, then you can partner up with others that may be willing to come to the table with you. They will co-guarantee the deal with you. And now it's the stacking of your net worth with all your other partners that then is looked at. And that's really the beauty about investing in multifamily as well as other commercial real estate.
It's always about leveraging the team.
That's exactly, it's leveraging the team. Now that is the financial element to it, right? So now leveraging the team also is important to understand that you need to bring experience to the table in one form or another. So now for banks, they may be a little bit more flexible, but when it comes to the agencies, they have the expectation that you or at least one of your team members have a pretty significant experience in multifamily, right?
And is this where it comes into the investor's benefit to have, their loan package created before they go to submit for the financing? So like their background, their business plan, their strategy, all this nicely laid out, and submit that with the loan package so it makes them looks better and kind of highlights their strengths. Is that
yes, absolutely. The story of the sponsors is now more important than ever, right? And frankly speaking, I would recommend anyone who is active in that space, put your team together and come up with that story and know what you can do from a net worth and experience perspective before you even submit an LOI, right? Because once you submit an LOI, as you know, right, everything breaks loose and you think you have plenty of time and everything is
it starts getting real when the offers start going in.
Yeah, so you want to avoid that. Putting your team together, you can do ahead of time, right? So now I also wanted to touch on this because that has been brought up now over the last few months quite regularly. In the past, we recommended for a newcomer to go with a Freddie SBL loan for a stabilized property because Freddie SBL was very tolerant when it came to new sponsors. So we did deals for someone who didn't have any experience, had the net worth, but didn't have any experience in multifamily. And as long as you had a third-party management company that you hired, Freddie SBL was willing to finance that deal, right? So you had that ability to do it without any prior multifamily experience. Now, naturally, last year and now particularly this year, Freddie has tightened these rules. And now the official rule is that you need to have, as a team, 3 properties that you have experienced, multifamily properties of a similar size of what you are looking at now over a period of 2 years plus, right? So that's pretty tough requirement. Now you can waive it if you have a strong financial strength or you bring one partner in that is local to the property, they may waive it. But it's still very tough to waive, and we have seen quite a number of deals where Freddie pushed back on it. So it's just important that, right, whatever we said and others may have told you a year ago, these rules have changed.
Yeah, so they're definitely changing. So definitely get up to date on them for sure.
That's
if you're looking for them. So based on what you're just saying with the SBL, the small business loan, like for me, for example, like somebody that has around like 10 units, say just Joe down the street has 10 units and he's applying for, and they're residential units, applying for a loan, for a commercial loan, for SBL loan. Would he still qualify if he gets the professional property management, or do they want to see other commercial multifamily experience now with the changing requirements on that?
Yes, they really want to see that experience for that size of or similar size of a property that they apply for, right? So even if you had duplexes, doesn't count. If you had quads, even if you had, let's say, a couple of properties that were maybe 10 units or 12 units, whatever it is, and now you look at, let's say, a 50-unit property, then that is a tough discussion to have, right? So if you have a long-term experience with, let's say, multiple properties that are 10 to 20 units, then I would say we could make the argument that it's close enough. But if it's just fourplexes, let's say, compared to a 50-unit property, then it wouldn't fly. So very often it's a judgment call, but the closer you are to the property in terms of experience to the property that you're looking at, the easier it's going to be.
Gotcha. Yeah, that's good stuff. I wanted to break that down so people get an idea of, what they need to kind of have going forward when they're looking at these commercial multifamily properties. And I wanted to backtrack just for a minute quickly on like the liquidity and net worth, because I wanted to give another example here too. So if there's, say I'm looking at a 50 unit complex, it's in a good market. So it's 100,000 a door. It's $5 million. For $5 million purchase price, we go off the $4 million in debt, like you were saying before.
Right.
And say me and a partner combined, just one partner, we have, each $2 million. So combined $4 million of liquidity and 4 million of net worth and 400,000 of after closing liquidity based on those requirements. That's a scenario when we'd be able to get that loan, correct? Based on our net worth and liquidity.
That's right. Yes.
Okay. Now, if I have one other partner, say I'm at $1 million, which I'm still a little bit under that, but if I only have $1 million net worth and 100,000 liquidity, and I just bring on a partner to sign is that a situation where they'd be the guarantor on that loan and they'd be responsible for that liquidity? Would I have to cut them in for equity, or could it just be somebody that meets those requirements and can sign for me if it was like on a personal relationship basis?
Yes.
There is no better asset class for building wealth than real estate. And in most instances, people don't have the time or energy to invest in it on their own. So how do you build wealth with real estate when you lack the time and energy? Leave that to the GrowthView Properties. The GrowthView team finds, negotiates, and manages multifamily assets for private investors. Their mission is to help investors secure the ultimate asset, which is time, all the while impacting the greater good with their endowment fund that fuels the mission of charitable organizations. Find out more by going to thegrowthview.com. That's view with a VUE.com. Put your money to work so you don't have to at thegrowthview.com.
Basis.
Yeah, so they can be a limited partner without being on the GP side. Personally, I would recommend for someone not to come in just as an LP when they guarantee the loan, even if it's a non-recourse loan. But the reality is some people are comfortable enough to do that, right? So it's ultimately up to a sponsor to see what they can negotiate, right? So that is definitely doable. However, the lender still would want to see that guarantor. It still would be a key principal. It just would not be a general partner in the deal.
Okay, yeah, that's why I wanted to distinguish on if somebody had the relationship with a high net worth individual, that they could potentially be the signer for these loans, but not have to be on the GP of the management side of the deal.
So that's definitely doable. Yeah, but they still would like to see that individual also invests money into the deal, not just signs on it, even if it's on the passive side, that it's very clear, yes, that individual is committed to that deal, or has skin in the game beyond just guaranteeing, right?
Okay.
That is actually, maybe we can touch on that a little bit too. In the past, it was easier to get deals done when you were a newcomer. Maybe if you brought in only 3 to 5% of your own money into a deal in cash contribution of the actual cash raised, right? So not what you have then in your split and all that, but actual cash equity contribution. Now, obviously, the weaker the sponsors are, the tougher it is to get a deal through, the tougher the location. More likely than not, the lender will ask for a higher percentage, whether it's 10% by the sponsorship group guarantors, maybe 15, maybe 20%. It all depends, right? So that is another element I think that one should think of, that the tougher the deal, the more likely the lender and the agencies will ask to increase your equity cash contribution in the deal.
Yeah, that's good. So basically find a good deal, have your stuff together, put it in a nice package and get it.
That's right. Yes.
Yeah, that's good stuff. Yeah, I think people are going to have to like rewind this a little bit because we're throwing a lot out there and you're providing a ton of value. So thank you. So hopefully people are getting a lot from this. I sure am. I'm writing my notes down as we're going. This is good stuff. Wanted to make a little transition now and just wondering, based on your opinion, when should the investor bring the lender into the deal? Is it before they ever submit the offer, or when's the best time to get that underwriting going?
Yeah, that's a very good. Yeah, that's an excellent question. Right. So obviously, if everyone has a different approach when it comes to submitting LOIs. Right. So there are some out there that are tossing out LOIs left and right and see what sticks. Right. So now, if you're that type of a sponsor, then I would say approach a lender after an LOI was accepted. As long as you're comfortable that you actually can get the financing, right? So my view is it's not really, from my perspective, not the right approach just to toss out all the LOIs, as many as you can, and see what sticks. But if some have that strategy, and for some it has worked out really well, the more typical sponsors are underwriting deals and they are really understanding for what they want to submit that LOI so that they know that they don't have to retrade once the LOI is accepted. Yeah. For those type of operators and sponsors.
Yeah, basically for those listening, retrading is like when you get the deal under contract or under LOI and then you go back and say, okay, I changed it. I want a lower price because I found something. Basically, Anton's saying, like, for those that do the diligence up front and really find what they want, they submit the price based on everything they find. They don't have to retrade later. So sorry, I didn't want to.
Yes. Yeah.
That good.
No, and I think obviously both strategies work. My view is particularly the larger the property, the less successful you're going to be with just tossing out LOIs, because brokers will know very quickly that you're not a reliable buyer, right? As soon as you retrade without any reason, just because you didn't underwrite it properly to begin with, you will not get any deal from that broker down the road. Yeah. And then
brokers do not deal with retraders, that's for sure.
That's right. So that's why I suggest to really underwrite these deals properly before you submit an LOI. Now, when should you involve a lender? My personal view is that you should underwrite the deal for yourself, make debt assumptions, and based on those assumptions, you need to decide whether it's a go or no-go in principle, right? So once you say, okay, I made the initial underwriting, it still makes sense to me, now I want to submit an LOI, that's the point when you should reach out to us or to someone else who will validate your assumptions with you, right? So that you are confident that whatever loan assumption that you build in your model is actually achievable, right?
Yep.
And so once you submit that LOI, then you know that you can stick to that offer as long as your due diligence makes sense, right? That nothing comes back. And you can then, assuming that the LOI is accepted, then you will come back to us, and then we obviously do a much deeper analysis. We also go out and get actual quotes from multiple lenders to let lenders compete. So as you negotiate the PSA, or the purchase and sale agreement, you at that point, you will have a very good idea what your loan terms likely are going to be, or at least a range, right? It's important to understand in commercial financing, the terms are always subject to change until you have that loan commitment, but at least you narrow that range down to a level that is acceptable to you to get that deal done. And that's the path I would recommend for anyone who is really serious in multifamily.
Yeah, that's good stuff. So just as a recap for everybody listening, so basically search for deals. You should be out there screening, getting deal flow, talking to brokers. First of all, you got to find the deals before you ever get anywhere else. Then you find the ones you want, submit the LOI, then you get the purchase and sale agreement, the PSA. And that's when you're starting to have the conversation with the broker. You know, if everything meets your assumptions, and you submit the contract, obviously you want to start talking with the lender. during this time, you're doing all your due diligence, checking out the property, making sure your rehab budget is what you think it's going to be. And then once you get through due diligence, that's when you get to the deeper underwriting, the term sheet. And then once that process is through, you get the loan commitment from the bank, and then you close and operate the business plan.
Yeah, actually, a lot of that work is done already up front, right? Just to give you a brief breakdown how it typically works with our clients, right? So they find a deal, either it's a so-called off-market, even though none of them are really off-market, right? So even if it's through a broker or a seller direct, they are peddling that deal with a lot of prospective seller buyers. But whether it's an off-market or a broker deal, once you look at the deal and you like it, right? So our clients then come back to us and tell us, okay, here is the T12, here is the rent roll, that's the OM. What do you think can be done here with this deal, right? So then we underwrite it and we come back with that guidance. We call it indicative quotes or preliminary quotes, whatever you want to call it. But that essentially we do before they submit an LOI. So once they submit an LOI and it's being accepted, then we start collecting hard quotes from lenders. So at that point, we've essentially want to know who are all the KPs, the guarantors. We want to see the PFS, the rent, the REOs, right, the real estate owned schedules, the bios of all the partners. So based on that, the lender is able to come up with a pretty tight, hard quote based on that information. And then once the PSA is accepted, then they also can issue a loan application, which is as tight as possible. And that's really the goal for us, that there is not really much wiggle room as long as the due diligence after the PSA is signed is not uncovering major issues and the collections are not dropping, that the likelihood for having a lower loan amount or completely different terms is as small as possible. Right, so that's ultimately.
So we don't have to retrade the lending terms either.
That's right. Yes,
that's good. Yeah, I'm glad we broke all that down, because I think that's an important distinction to make, and I'm glad we clarified, because it is important to understand the commercial multifamily world. The process takes a little bit longer, but as you can see, everything Anton just broke down, there's a reason, because there's a lot more diligence, than closing a single family house where you put in the offer and close 30 days later. So that's really good. Get some kind of indication from the lender, and see what they think about the deal. Cause they're going to essentially be your partner on this deal, get some kind of terms up front and get their 2 cents on it before you submit the offer, to make sure that, you can move forward and not have to retrade later on.
Yes. So now there is also an additional important aspect I want to bring up, and that is how realistic are these quotes that you're getting from brokers and lenders, right? There is a tendency out in the market, right, where obviously everyone is competing with each other, right? We compete with other brokers, lenders compete with other lenders. And because of that, brokers and lenders tend to be overly aggressive, right? So they present you with loan terms that may or may not be achievable, or they may only be achievable for the best sponsor in the best case scenario. But you may not know that that is really a best case scenario. That's very unlikely that it's achievable, right?
Yeah, that's a good point. I think me and Joe Fairless might get different loan terms.
Yes, absolutely, right? So that's just the reality, right? And even Joe Fairless will not get all the loan terms that institutional investor is going to get, right? That's just the reality that everyone has to deal with, right? And so that happens, unfortunately, a lot. And and that's why I believe engaging a more commercial mortgage broker that really understands the game is so crucial, particularly when you start out, right? That you have someone who is willing to tell you, look, yes, you get these term sheets, but here is the reality, right? So we always shoot for the moon, but you need to be realistic what might happen, rather than just believing whatever a lender or a broker tells you.
Yeah, I think that's a really good point to make, because a commercial loan broker can more than pay for their service over and over again if they get really good terms, especially if it's, on a 10-year fixed term that just extrapolates out. If you lock in that lower rate or those better terms because you had some competition on your loan, then you just did a good deal. So I think sometimes people overlook that and say, oh, I've got a lender I prefer. But getting different opinions, getting that competition, like you're saying, that's what drives prices down, which is good, as long as it's honest and trustworthy. So moving on here, I know this varies, but broad question, because we're talking about all this diligence that goes into it. How long does the underwriting usually take today? I see, sometimes 30 days due diligence, 30 days lending period with a 30-day extension if needed. So usually 90 days or under, and usually the faster the better, because it's a seller's market. So you want to try to stick out. So how long are these loans taking?
Sure. It certainly is different from when you look at the bridge loan can be closed in the most extreme case with high cost loans within a week, right? But the typical bridge loan probably takes around 30 days to close to 45 days. The bank loans are also in that 45-day range, typically 45 to 60. Now, when it comes to the agencies, because we obviously in multifamily, everyone wants to essentially know, can I get into a Fannie or Freddie or a HUD loan? Now, when it comes to Fannie and Freddie, it's typically around 60 days.
Okay.
If everything falls into place perfectly, if the sponsor is really responsive, as well as the seller is responsive in delivering all the due diligence items that are required, then you might be able to do it within 35 to 45 days.
Yeah, that's good stuff, because I think that you have to be cognizant when putting in your offers, like how realistic you can be with your timelines, especially if you're just getting into it. You're not used to the lead time it takes to get these big commercial loans closed.
That's right. Yes. Yeah. And when I talk about the time it takes, it's really from a signed loan application, right? So not the discussion, but once you sign that loan application. Now, I would also say is with COVID-19, you really should build in extension options. What we recommend is essentially close 60 days after the effective date, right? So right now, that's typically in most markets is acceptable to most sellers, and build in 2 times 15 days or 2 times 30 days extension options, so that you have that flexibility if things go wrong, that you can stretch it out a little bit. I would also recommend to put in some form of a COVID clause, right? So if things shut down and lenders cannot inspect, third-party inspectors cannot travel, cannot come to the property, maybe tenants do not want to come into the units, who knows? Maybe the city says you're no longer allowed to inspect. Yeah. So you should have some form of a COVID clause in your contract that allows you to extend it out too.
Yeah, that's super important. One of the deals I did in April, like this was 2 weeks after the country shut down. It was like the last week of March, first week of April. Like people just weren't in the title office. They were like working from home and just not there. So we couldn't get the title work processed, and it pushed it out another 2 weeks. So that was aggravating. But had we planned for it, it would have been no problem because we had it in the contract. Sure. Luckily, it still worked out. So that was good. But I know you mentioned this a little bit earlier, but with the reserves, and I know it's going to depend on the loan product, but what are kind of the typical reserves that people should expect to be really adding to their capital stack? Because they're going to need to raise that on the front end to close the deal, or put up that additional capital themselves. So what should you expect from that perspective?
Yeah. So it depends essentially by the leverage of the loan, right? But when we look at so it's from none that can be waived if the leverage is low. Typically, it's 55 to 60 or 65 or lower when the principal and interest escrow is waived. But for a typical sponsor, they always want to be at maximum leverage, right? Which means it's usually somewhere in the 70 to 80% range. So when we look at that particular leverage level, we are still for a Fannie conventional, we are still at 12 months. For a Fannie small balance loan, which is up to 6 million, we are still at 18 months of principal and interest, which is quite a bummer because that's more than anyone else. For Freddie SBL, it is 12 months, and for Freddie conventional, it's 9 months when you go for these full leverage loans. The only exception I would say is that you may have, if your debt service coverage is extremely strong despite a full leverage loan, let's say above 140, that you may be able to lower that requirement. But frankly speaking, we haven't seen that many full leverage loans where out of the gate your debt service coverage is already 140 and above. It may happen, but it's pretty uncommon.
And that's talking about the cash flow, the debt service coverage ratio being over 1.4, meaning the cash flow is 40% higher than the debt service. Yep.
That's right. Yes. And that's, by the way, that's based on the lender underwriting, not whatever is in place right now, and not how you or anyone else underwrites that cash flow, right?
Yeah, which is an important distinction.
Yeah, so because that's very often, right? So someone will say, well, it cash flows extremely well. Well, based on what? Because the seller is telling you that they can operate at the cost ratio of 30%, right? Because they didn't really fully load the cost, or because it's you base it on your 1 year pro forma, right? Which again, the lender doesn't care about. For an agency loan, a bridge loan is different, but for an agency loan, they don't care about your projections, and they also do not.
I love this because it's so nuts and bolts and just upfront, right? This is the stuff like you absolutely need to close multifamily deals. So I love the actionable advice in here, like knowing just the difference if you're going Fannie or Freddie, the difference, it could be a whole year of reserves right there. And if your principal and interest is another 50,000, you got to raise another 50 or 100,000. How's that going to change the returns? Because ultimately it's going to come from you and your investors and add it to your capital stack. So
absolutely
this stuff because it is like the front line of closing deals.
Yes. So now just to be right, obviously a lot of sponsors, a lot of our clients, they complain about that principal and interest reserve every day, right? So I understand it's painful, right? However, I think my advice is, look, I think in the current environment, obviously we see the end of the tunnel, right? With vaccinations now being rolled out. So hopefully by June of next year, we have most of it behind us. But considering that we may still have a pretty rough 6 months ahead of us where we just do not know where we are going, I would personally recommend to raise that principal and interest reserve anyhow, even if I didn't have to, right? So the only difference here is, in my view, is that now it's stuck with the lender, right? So you do not have the direct control over that money. But other than that it's sitting in escrow with the lender, I still would recommend to really raise that money anyhow, right? Even if it's a bank loan, you just want to have sufficient amount of cushion. And if you see in 6 months, 9 months that everything has blown over, return the money, right? So
yeah, that's great advice. I think you definitely want to be overcapitalized as compared to undercapitalized, because you don't want to have to be the syndicator or the operator that has to do a capital call and ask investors for more money up front because you didn't do your job in underwriting the deal conservatively enough. So that's a really good point. All right. So the last thing I want to get into before we transition to the last segment of the show is how newer investors can get bridge debt, like we were talking about, and fund to be what could be considered a distressed deal. So I know you said bridge debt lenders are have closed up shop a little bit since COVID. And then other ways that if they are working on a distressed deal, whether it's interest only or something like that, that they can make the deal look a lot more favorable.
So it really depends on, first of all, the deal size, as well as the the sponsor or operator quality, right? Their experience. If it's under 5 million as a loan amount, your choices are very limited to start with, right? So there, I would say you're more relegated to bridge lenders that tend to be kind of a hybrid between low cost hard money lenders all the way up to true hard money lenders, because they are just, the competition in that space is just not that big, right? So that means that typically,
so you're basically more favorable numbers to the lender rather than the investor, because there's just not a lot of competition as far as lenders.
Yes, that's right. And particularly then, if you do not have any past experience, then they also may still be willing to lend to you, but maybe at the loan to cost ratio that is not as aggressive as they would do it for a more experienced operator. Right, in the past, it was really common that you were able to get 80% loan to cost, right, where they financed 80% of the 80
purchase and repairs
of the purchase price plus 100% of the rehab money, right? So that was kind of the common theme. So very often you were at 80% plus for your total cost. Now, I would say it's probably tougher, particularly when you're a newcomer. You may be at 70, maybe 75%. But there are still players out there that if they see that you really can buy a good deal where they feel that there is a lot of value in the property, that you buy it clearly on the market, they may still be willing to do it. It's just that they increase the price. Very often it's personal recourse. So it's still doable. The terms are just not as favorable as for the larger and more established bridge loan players that there are, right? So we see these deals done between 7 and 10% of interest rate, whereas for more established players, for good property, even though it's distressed in a good market with an experienced sponsor, we may see still all-in rates that are around 5%, right? So they're really two different worlds, right? So one is for the established players, and then for the smaller or more experienced players, where it's likely much more costly than it was pre-COVID-19. Okay. But it's still doable.
So for the newer guys, expect to pay higher interest rates, likely be personal recourse in that bridge debt space before you're able to refi or sell. Yeah. So just a little bit less favorable to the investor. But if the deal works, right, if you're buying a good deal, then obviously
it might still be okay, right? So then some of them still do non-recourse, right? Even if it's a higher rate. But your alternative, I would say, is also look at, in those instances, maybe discuss it with a local credit union or community bank, right? So very often, particularly if you have already a relationship, maybe from the single family space, or you live close, whatever it might be, they may be willing to work with you, right? The leverage might not be that high, but then the terms might also be more attractive, right?
Yeah, that's a good point. That's what I've done most of my lending with so far, has been a local credit union, and they have, like you're saying, a lot more flexibility, especially if you have a personal relationship and you've done business with them before. So you can get more favorable terms that way, for sure.
Yes. Yeah. You know, less transactional driven, but more relationship driven.
Yeah, absolutely. All right, Anton, this has been awesome so far. Let's transition into the last segment, which is the Fortune 5. These are the 5 questions I ask every guest. So we'll just jump right into it. What has been the biggest thing that's contributed to your success?
Perseverance. I have gone through a lot of up and downs, right? With markets, with businesses, right? I've owned a number of businesses in different segments, from real estate, oil and gas, to retail. And I think it's just, you always learn from every single experience, whether it's good or bad. And when it comes to bad experiences, it's really the perseverance that you learn from that move on. Right?
Yeah, I love that. I think perseverance, if you don't have it, you probably never will find success unless you like win the lottery after putting $1 on black or something.
And as we know, a lot of lottery winners, they blow the money within.
Yeah, they go broke because they don't buy any commercial multifamily and invest in their future. That's why. All right. What's been your biggest mistake so far that's turned into a learning lesson?
I would say partnering up with wrong people. Due diligence of your partners, in my view, is absolutely crucial.
Yep. Yeah, I agree. Definitely you want to find the right team, find the people who match your values and aren't butt heads.
Yes.
All right. What is your favorite real estate or just business book that you would recommend for somebody starting out?
Well, I do not really have a specific one. Obviously, for I would say for syndicators, aspiring syndicators, you mentioned Joe Fairless. I think it's definitely worthwhile to read that or all of them. Right.
His book is really good.
Yeah.
What is the name of that book?
Yeah, I mean, he has a couple of them, right?
We'll put it in the show notes, Joe Fairless.
Okay. Yeah.
I think it's the best ever real estate syndication book.
Yeah, that's right. Yes, I think that's what it's called. But there are many others, right? I would say this is just when you start out. That's probably one of the better ones to read through. Yeah,
I agree. That's a pretty good book. So, Anton, what do you like to do outside of real estate and funding deals?
Well, I'm from Switzerland, so growing up with snow, I grew up with skiing, right? So I was, as soon as I could walk, I was also skiing. So that's still what I like to do the best. So whenever time allows, I'm in the mountains, either skiing or hiking.
I like it. Do you prefer the Alps or the Rockies?
From a snow quality, I prefer the Rockies. Yeah, definitely.
Okay. Yeah, it's good. That's where I learned how to snowboard out there too in Colorado. So I enjoy it.
And obviously, when it comes to quality snow, I would say within the United States, Utah is definitely the best.
That's what I've heard. I never got to go to Utah yet, though. So.
Yes, but if you want truly best snow, then you need to go up to Canada. Right, not the coastline, but just west of Calgary and along that mountain range there, where it's freezing cold, and that's why you have perfect snow.
Yeah, that's what I've heard too. So I guess the more northern you get better snow. Awesome. All right, so Anton, where can people find out more about you, connect with you?
So the easiest really is reach out by email. My email address is anton@peakfinancing.com. I'm also very active on Facebook. I'm active on LinkedIn. So it's I would say when you search me, I'm easy to find, and always happy to connect on all the social media. And if you have any question, please feel free to reach out. Right. So I live and breathe commercial real estate, and definitely live and breathe multifamily.
I love it. I'm right there with you. Anton, this has been awesome. Took a lot of notes today, learned a lot. Thank you for the insight. I thank everybody. I'm going to have to go back and listen to this just because as I was writing, as you were saying some other things, I was like, man, I just want to dive in deeper, but I could talk all day about this stuff. So appreciate you coming on the show. It's been fun.
Yeah. Thanks for having me on.
Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. And if you want to check out more on your multifamily journey, go to multifamilyjourney.com, where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.